Alright guys, welcome back to the channel. So today we're going to be getting into several strategies to lower your tax bill, and I'll be telling you how I personally went from paying the IRS $9,000 to getting a refund of $7,000. And as always, I'll have timestamps below so you guys can click around, but let's get into it. So the first thing I want to talk about is the philosophy of taxes. So you really don't want to be getting a tax return, and you really don't want to be paying the IRS any money. You want to be at zero when tax day comes around. And the reason I say that is if you're getting a large return from the government, that means that you gave the government an interest-free loan across the year. You gave them all this additional money that you didn't have to give them, and you got nothing from it. And if you get a large return from the government, that means that the government gave you an interest-free loan across the year. And they don't want to do that either. In fact, if you expect your tax bill to be greater than $1,000, the government actually wants you to file quarterly. And that's the reason why. They want you to be at zero. They don't want to have to pay you money, and they don't want you to pay them money. So let's get into some strategies to actually lower your tax bill. So the first way is by adjusting your withholdings. So it's a W-4 withholding. So the formal name is the Employee's Withholding Certificate. It's an IRS document that you provide to your employer, and it tells them how much they should withhold from your salary and pay to taxes. So if you go on this form online, there's a few different sections for if you're married, if you have a second job, how many dependents you have, and it steps you through how to fill out each section of this form. But the IRS actually has a calculator that you can use to fill out this form. And if you use their calculator correctly, you can actually project forward and pay $0 in taxes. So to use this calculator, you're gonna have to grab your last pay stub. So I'll leave a link to this calculator in the description down below, as well as all the other calculators that I use in today's video. But when you're filling out this calculator, there's a few different sections. There's an About You section. So you're gonna fill out if you're single, married, does your spouse have a job? Are you planning to claim dependents? There's an Income and Withholding section. So how many jobs will you and your spouse have that year? So if you have 2 jobs and your spouse has a job, how frequently you get paid. So if you're on a weekly, bi-weekly, monthly, and then you have to fill in your pay stub information. So when you got paid last, what was the pay period, how much you were paid, how much you've been paid year to date, how many taxes were withheld from that paycheck, and how much in taxes you've paid that year. If you're making any contributions to a 401k, so this is a traditional 401k, not a Roth 401k. We'll get into that a little later. If you're contributing to an HSA or an FSA, are you getting any bonuses? Also, you plug in if you have any additional streams of income. So if you have rental income, there's fields for that. And then there's another field for the estimated tax payments that you and your spouse have made year to date. So then you go to your adjustments for income. So if there's student loans or educator expense deductions, alimony, and then you're in your deductions. So the standard deduction is what I would recommend most people do, and I'll get into that in a little bit. And then qualified business income deduction. And then tax credits. So this tax credits section is where you should be careful. So you're gonna plug in your age and your spouse's age, your number of dependents. So this number of dependents that you plug in is actually your withholding number. That's the number that's really going to influence how much you're paying in taxes. And this earned income tax credit, this is where you really need to tread carefully and make sure you actually meet all the requirements to click this box. So 50% of the IRS audits that happened last year were for people who were claiming the earned income tax credit and they weren't supposed to. And you'd be wondering, like, why the earned income tax credit? People who are claiming the earned income tax credit are definitely at the lower end of the income spectrum. The reason is they don't have to send an actual IRS agent out to do these audits. They can just look at the income that you claimed for the year, see if you qualify or disqualify for this credit, and just send you a bill saying, hey, you weren't supposed to get this credit. So they're just a low-hanging target, where if you're going after someone with millions or billions of dollars, you're going to have to come with a team of agents to comb through all their different businesses, all their different accounts, all their different records. And yes, they could get more money from those, but it takes more resources. And the IRS has been strapped for personnel for a few years now. So they've actually been targeting people who claim this earned income tax credit. So you definitely want to be careful that you don't claim this and you're not supposed to be getting it. There's also some other credits for foreign tax credit, education, retirement savings, disability, business. So fill all that stuff out to the very best of your ability. And then it's going to give you a result. So with the made up numbers that I plugged into the calculator, it's saying I'm projected to get a $9,000 refund. And what it does is it actually gives you a recommendation of how you should adjust your W-4 withholdings to zero out your refund. So you're not giving the government an interest-free loan for the year. And if you were going to owe money to the government, they would give you another recommendation of how you should adjust your W-4 so you don't owe the government money and the government's not giving you a zero interest loan. And it's very nice because they give you a field where you can actually download the pre-filled out W-4 and then give it to your employer. Like you just print it out and hand it to your employer with the suggestions from the IRS so you know it is correct. So this is an amazing tool and something I didn't stumble across for many, many years. So that's how you zero out what you're paying to the government. That's how you don't owe them money, and that's how they don't owe you money. So now you might be wondering, well, how do I lower the amount that I'm paying? So I don't want to pay more than I have to or less than I have to, but how do I actually lower the burden of how much I have to pay? So my first suggestion would be increasing your contributions to your pre-tax retirement accounts. So this is the traditional 401k or your traditional IRA. So when someone says traditional or Roth, what they're saying is a traditional retirement account, the money goes into the retirement account pre-tax. Where a Roth retirement account, the money goes into the retirement account post-tax. So when you're putting into a traditional, what you're saying is you think that the amount of income that you're bringing in now is going to be higher than what you're going to be taking out in retirement. So the tax rate that you're experiencing now is going to be higher than the tax rate that you think you're going to experience in retirement when you're withdrawing those funds. Where in a Roth, you're saying that the taxes I'm paying now are going to be less than the taxes I'm going to pay in retirement. So the general strategy I would adopt is if you're early in your career or your income is low, contribute to a Roth IRA or a Roth 401k. And as your income climbs, then you should start contributing to a traditional IRA or traditional 401k. But if you actually want to get a tax benefit, the only way you can get a tax benefit is by contributing to that traditional. For a Roth 401k, if you make too much money, the government actually prohibits you from contributing to that account. So if you're single, so this is a 2024 number, if you're single and you make more than $161,000, you are precluded from continuing to contribute to a Roth. Once you hit that modified adjusted gross income number, you can't contribute anymore. And then if you're married filing jointly, the limit is $240,000. And if you're married filing separately, the limit is $10,000. So that sounds a little ridiculous or like a typo or an error, but it's not. So if you are married and you are filing separately and you make more than $10,000, they don't want you contributing to a Roth IRA. So if you are a newlywed and your plan for that first year of marriage is to file separately, one of the things you could run into is you contributed to a Roth IRA in the previous year and you weren't allowed to based on your income. So it's definitely something to consider if you know you're getting married. So one thing I wanted to really discuss is the relationship between adjusting the amount you contribute to your retirement accounts and its effect on your taxes, because it's not the easiest to see without using calculators. So I'll leave a link in the description down below to this calculator. But for the purposes of this example, we're going to be comparing if you contribute 0% to your traditional 401k to whether you're contributing 10% to your traditional 401k, just so the numbers are easier to calculate and compute. So, and for your gross pay, I'm going to assume that you make $1,222 every week. And you're like, that's a weird number, but I'm going to show you in a second why this number works. So if you click View Report, the first thing you're going to see in this report is going to show you what those contributions will do across a 34, 35-year working career. If you kept contributing and the market had a 7% return, it's going to show how much money you're going to have in that retirement account. And you can see it's a nice chunk of change that accumulates in this retirement account across that time frame. And it also shows you with that 10% contribution how your take-home paycheck is reduced. So I picked that weird number so you could see the take-home paycheck with a 0% contribution is $1,000. And with that 10% contribution, you're reduced 10%, so your take-home paycheck is $900, right? So let's keep scrolling. This is where it gets interesting. So this is more breakdown on your contributions. But the section that's really interesting is this paycheck withholding summary. So if you scroll down to this federal tax section of this withholding summary, you can see that with 0 contribution, our taxes on that weekly paycheck are $70.33. And with the 10% contribution, our taxes are $55.67. So you can see that it's more than a 10% reduction in our tax bill. So it's not like we lost that money. That 10% is going into our pocket and we're getting more than a 10% reduction in our federal taxes. So if you know later in life you're going to be making less money than you're making now, and you're going to be in a lower tax bracket, then it's it's very beneficial to increase your contributions into your retirement account and lower your tax burden as much as possible during your working career and get this outsized reduction in your tax bill. So we mentioned the traditional 401k and the traditional IRA as accounts that you can contribute to lower your tax burden now, but some other accounts that you might consider are a health savings account or a 457 if you are a state or government employee. So that HSA account is actually triple tax advantaged. Damn! So the money that goes into an HSA account is pre-taxed, and then any gains in that account are not taxed. And you can actually spend the money today without paying taxes on it, as long as what you're spending it on is an eligible health-related item. So this HSA account should not be confused with an FSA account. So an HSA account, the balance in the account actually rolls over from year to year to year, where an FSA account, the balance does not roll over. So if you're in a high deductible savings plan and they offer this HSA account, it's actually a very beneficial account to contribute to. But the FSA accounts, I personally do not like, just because if you don't use the balance in that given year, the balance goes away. So the next thing we want to get into is deductions. So I mentioned it a little bit earlier, but the standard deduction is what 99% of people should be taking. And the biggest reason I say that is because whether you itemize or take the standard deduction, you can still claim business deductions. And most people, the largest deductions that they're going to be taking are going to be related to business activities. Like, they don't have that many personal deductions that they're going to take. So if you're single, the standard deduction number for 2024 was $13,850. And if you're married filing jointly, that number was $27,700. And if you're head of household, that's $20,800. So unless your itemized deductions are going to be higher than those standard deduction amounts, then there's no reason to itemize. So my wife and I have multiple investment properties, multiple businesses, and we still take the standard deduction. Itemizing is not beneficial for us. So this next piece is really digging into why business deductions save you a bunch of money. So I'll preface this by saying I'm not a tax professional, I'm not a lawyer, but feel free to contact those professionals and validate what I'm telling you. But if you invest money into your business at the end of a year, you can take very large business deductions and lower your tax bill. So this is actually how I went from paying $9,000 in taxes to getting a refund of $7,000. So my wife has a luxury handbag business, and she had a bunch of income toward the end of the year. And instead of rolling that money over into the next year in an account, she reinvested all that money into more handbags as a business expense. So all those handbags are going to make her money in the next year, but for accounting purposes, it doesn't look like her business made any money. And by doing this, we have a very large business deduction instead of showing business income. And just that small tweak changed our tax bill from $9,000 to receiving $7,000. And this strategy works great for if you have an LLC. It works if you have an S-Corp as well. And This reinvesting strategy is why a lot of the large corporations make billions and billions of dollars and they still pay $0 in taxes. They're just reinvesting money into their business to lower their tax burden. I'm sure there's some other methods that they use, but this is one of the main ways. But if you are an S-Corp, there's some more advanced strategies that you can use to lower your tax bill. So an S-Corp or an LLC filing as an S-Corp. And the best way to show this is with a calculator. So what this calculator does is it's comparing if you take your entire salary from a business as a salary, so all the money from your business as a salary, or if you're an S-Corp, taking part of your money from your business as a salary and the rest as an owner distribution. So the difference is the owner distribution gets taxed at an ordinary income rate, which is a lower rate than what a salary gets taxed at. And you're able to do this if you're an S-Corp or you're an LLC filing as an S-Corp. So let's scroll down here. So you can see that the salary we're assuming is $50,000. And then for this S-Corp, I'm going to assume I'm going to take $20,000 as a salary, and then the additional $30,000 is going to be an owner distribution. So if you scroll, you can see that you would pay $7,650 if you took all of that money as just straight salary, but you'd only end up paying $3,000 if you were doing the split between salary and owner distribution. So that saves you $4,590 in taxes. So this is a completely legal strategy you can use to lower your tax bill if you have self-employment or if you have an LLC or S-Corp to lower your tax burden. This strategy of changing how you receive your compensation is actually a strategy a lot of CEOs and people with a lot more commas in their bank account than I could ever dream of use all the time. So it's not uncommon for a CEO to take $1 in salary and then the rest of their compensation package is in stock. It's these owner distributions. And that gets taxed at a much lower rate. It saves a ton in taxes. So the next strategy I want to talk about de-stressing tax time is a very simple one actually, and it's what I use for many years. And it's just setting money aside for what you expect to owe in taxes. So when I first joined the civilian workforce after leaving the military, I owed about $3,000 to $4,000 in taxes each year. So I just set aside $3,000 to $4,000 in a savings account. So when that tax bill came, I already had the money in an account to pay that tax bill. And putting it aside in that account, it was able to gain interest. So I was actually making a little bit of money by doing my taxes that way. And another way you could do it is by adjusting your additional withholdings. So if you're W-4, you're claiming 0, you can actually adjust your additional withholdings up and zero out your tax bill. And we showed that earlier in the video. So the final way to lower your tax burden that I wanted to talk about was tax loss harvesting. So if you have capital gains from investments, you can actually offset those capital gains if you have capital losses from another investment. Now you are capped with how much money you can actually claim as a capital loss in a given year. But if you have a larger capital loss than what you can claim in a single year, you can actually roll over those capital losses from year to year and keep claiming that capital loss against your capital gains. So it's a good strategy to lower your tax bill. So if you know you have capital gains, you can sell something that has a capital loss and claim that loss against those gains to try and offset your tax bill. So this is a bit of a bonus discussion here, but while I was researching this video, one of the big questions that crossed my mind is, why do wealthy people always file an extension on their taxes and pay and file their taxes in October? So if you pay your taxes in October, you're actually paying interest on those taxes from the April deadline all the way to October. It's a pretty small amount, but you are paying interest in that entire time frame all the way into the October deadline. So I never understood why very wealthy people did this, but I'm starting to bump into some of the reasons why wealthy people might do this. So if you have K1s, so K1s are tax documents that you received for business investments. So you can get a K1 if you're investing in a stock or a REIT or a startup or some whatever. There's a bunch of different business investments that they give you a K1 document. And these K1 documents take longer to produce. So my wife heavily invests in startups, and she might not get her K1s until a week, 2 weeks before the April deadline. And in fact, some years she doesn't get her K1s until after the deadline. We've seen K1s rolling in August and September before the October filing deadline. So you have to file amendments to your taxes to actually get that documented correctly on your taxes, which is very inconvenient. So the wealthy actually will extend out just so they have their taxes correct. So all the documentation is there. And the other big reason they do it is because they can plan better. So if you were trying to do your taxes at the same time everyone else is doing their taxes, you don't have that dedicated tax professional to really dig in to find all the potential deductions for your specific case. But if you give him that additional time without all those clients that are filing in April, then they can dig into your businesses, your files, do some strategic planning to lower your tax burden. So even though they're paying interest in that time frame from April to October, that additional time to do strategic tax planning actually saves them way more money than they end up paying in interest. So that's the video. If you made it this far, you know how to save money on your taxes, but you probably are also interested in raising the amount of money that you make each year. So I made another video on how you can get 100K a year in revenue from a single Airbnb property. So you can check that video out and boost your income. Thanks for tuning in, and I'll catch you guys next time.